The pluses of a crowdfunding platform are as follows. Number one, they tell you about an investing opportunity, sponsor, or fund you might not have otherwise found out about. Number two, they have theoretically done some of your due diligence for you. It's not a guarantee that the investment will do well by any means, and it doesn't excuse you from the need to do due diligence. Number three, you often get a lower minimum investment, sometimes just a few $1,000s. That could be lower than going directly to the sponsor. Number four, you may also get better terms than you would get going directly to the sponsor. Number five, the platform may also offer its own products, such as a REIT or fund that invests in multiple of the deals on the platform. Naturally, a crowdfunding site has some negatives as well. Number one, they have to get paid too, so there is an additional layer of fees. 1% of the amount invested is pretty typical, but that obviously reduces your return from what it would have been without the platform by 1%. Number two, these platforms are most attractive to sponsors that have trouble raising money on their own. The platform helps them raise money to do the deal. That means one of two things and sometimes both. Most commonly, it means they are a relatively new sponsor. Established fund managers or syndicators have a lengthy list of prior investors to hit up when they have a new deal. They often don't need to go through a crowdfunding platform to get more investors. However, it can also mean they're just not very good at what they do. Sometimes that's just because they don't have much experience, but it could be indicative of other problems too. Hopefully, the crowdfunding platform can weed those with prior problems out through their due diligence process, but no guarantees. And anyway, you're still going to be left with relatively newer folks most of the time. The platform has a huge conflict of interest. While their reputation is very important, they don't make money if they don't put deals up there. So their incentive is to get as many deals as possible. You'll notice they also are generally paid whether you make money or not. Number three, the platform can go out of business. This does happen occasionally. The largest platform out there, RealtyShares, went out of business a few years ago. I had an investment with them. Now, all of these platforms have a plan if this happens, and RealtyShares did too. The investment completed as planned. There's definitely some additional hassle and worry. Number four, deals are often snapped up instantly, before anyone besides the platform really has time to do any due diligence. That can't be good to have an entire investment filled by investors who didn't do due diligence. Sometimes that doesn't bother the investors since the investment minimums are so low they're very diversified, but it still isn't a good thing. Many investors get started by using these platforms. Those who continue to use them tend to be investing relatively small dollar amounts. If it's hard for you to come up with $50,000, $100,000, or $200,000 minimum investments, it's likely a reasonable option for you. You just have to weigh whether it's still worth it while paying that additional layer of fees.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.
House hacking is when you buy a property that you live in, usually a house, and then rent out parts of it. While the term is fairly new, the concept is not. People have been doing this for a long time. In its most simple form, it involves buying a duplex, living on one side, and renting out the other. But people have taken it so much further than that. Some people do it with short-term rentals, usually using a service/website such as Airbnb or Vrbo. They may be renting out a mother-in-law apartment, a bedroom, or even a couch. However, the term is generally used refers to long-term rentals in a house. For example, instead of renting an apartment or buying a condo as a resident, perhaps that resident buys a 4-bedroom house and rents out the other 3 bedrooms. Or even gets really aggressive and rents out half of his or her bedroom and rents each of the other bedrooms to 2 separate people, and maybe even rents out the den downstairs. The advantage of doing this is simply the extra income. For example, imagine you rent out 3 of your bedrooms for $600 a month. Now you have $1,800 that can go toward your mortgage and other expenses. This will reduce your cost of ownership and perhaps even allow you to live completely free when there are no vacancies.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.
Medical school is expensive, from the application process, tuition, and the potential mountain of student debt that comes after graduation. You'll earn enough to make repaying your loans manageable over time, especially if you live like a resident for 2 to 5 years after you become an attending. Now, if you're thinking of becoming a physician solely for the potentially high salary, you might want to reconsider. 4 years and upward of $200,000 is a lot of time and money to pay or borrow to wind up with a job you might not end up liking very much. But if you consider the salary, job security, and the fulfillment you can get from helping others, becoming a physician can very much be worth the cost of medical school. Most physicians who make it through would likely say the same.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.
Publicly traded real estate is real estate that is traded in the public markets, primarily the stock market. It is a highly regulated, extremely liquid market with a great deal of transparency. These investments require the least amount of hassle of any real estate investments. They also provide the most liquidity and diversification. They do not require any significant expertise in real estate at all. These investments are extremely passive and are simple to report on a tax return. Sounds great, right? Well, there are some downsides. The main one is a lack of control. There will be no opportunities to add value to these investments, and you won't be able to control what is bought or sold, when properties are bought or sold, or how properties are managed. These investments will not be passing along depreciation to you either, at least not directly. Someone else will be managing every aspect of this investment for you, and they will all want to be paid. Those payments will necessarily be taken out of your return.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.
A publicly traded real estate investment trust, or REIT, is an individual company like an individual stock. However, that company owns many different properties. For example, American Tower is one of the largest REITs in the world. It has a market capitalization, i.e., what the company is worth, of over $100 billion. The company owns over 200,000 different properties. Obviously, that's pretty diversified. If just one or even 1,000 of those properties does poorly, you're still going to be okay. So while it might be unwise to own just a few individual stocks due to a lack of diversification and what we call uncompensated risk, that isn't quite as dumb when it comes to REITs. There are nearly 200 different publicly traded REITs. Real estate makes up about 3.5% of the stock market. When you buy a total stock market index fund, 3.5% of the amount you put into that fund is actually invested in real estate.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.